In this episode, we're going to be unpacking Mill Park as requested from one of our viewers in the comments.
So Mill Park's been talked about in the whole property investment network for a little while now. So we're going to break it down and see whether it's worth purchasing and if you can make some money out of it.
Median rent is around 5.21.
Yeah.
And the gross yield of 2.81. It's not great.
It's not great. So your downside in the worst economic outcome, you're going to get negative 1% growth. But if all goes well, you've got an upside of 14% growth. If you're an owner-occupier who wants to live in Mill Park, you're certainly going to increase your property value. But if you're an investor...
So the location, it's about 19, 20 Ks northeast of Melbourne CBD.
Yep.
So not far at all. It's known for a family-friendly lifestyle, street, leafy green, proximity to university. There's a Westfield. Yeah, it's not a bad area as far as I can see. I'm not
typical family-friendly outer suburb of the city.
Yep, strong public transport network and bus network as well.
So population demographics, there's a clear imbalance in population to current dwellings. So 28,700 people compared to 11,800 dwellings. So that's always, we've got to look at current supply to future supply, but current supply shows that there's a clear imbalance with supply and demand. School rankings, 60 out of 100, socioeconomic score 5 out of 10. So, not spectacular, but also not bad. Renters to owners in that market, which is, again, really important from that supply side, where you've only got 23% of the market being investment properties. So we know that majority of that market is driven by owner-occupied buyers and owner-occupied income, which is... like we just said in that introduction, it's known for its family-friendly lifestyle suburbs. So renters to owners, that's really good. And units to house, there's only 10% units in that market, which is probably in line with the investment properties being around that 23% because a lot of investors are probably just buying units.
Yeah, and there's a average years to own is 45 years.
Yeah.
That can indicate lower affordability, because people are refinancing and extending terms out.
I believe, and we'll bring it up in the graph, but I believe it is currently trading below long-term affordability trends. So it does indicate that there's short-term upside in that income to support those prices continuing to grow.
So a typical house price is around that 960,000 K. Median rent is around 5.21.
Yeah.
And the gross yield of 2.81. It's not great.
It's not great. I reckon you could get like a decent, if you're catering to a big portion of the market, say, families, if you're going a 4-bedroom house, you're probably spending $1 million, you might get a 3% yield, maybe a 3.5%. But it's still not great. And from an investment perspective, when you're paying land tax on top of it and you're only getting a 3% yield, it's just super expensive to hold onto your property.
Growth indicators, in the last year, it's gone up 0.43%, so very small. Even in 5 years, it's 21.29. Again, not much at all. And 10 years is only 79.
Yeah, 80% isn't bad. Like, it's just average growth.
Usually, you'd usually hope to double your investment.
You'd hope to double. Yeah. 100% is a good market. 5 years though, to have that growth over the 5-year period, that's also considering that really rapid increase in COVID-19, the 2019 to 2020 period.
Yeah.
So the fact that we had ultra low interest rates during that time and the market still has only done 20% over that 5 years, it is a little bit concerning, but it is a pretty volatile market. So
that whole area, well, Melbourne in general, has been, I guess, underperforming for the last few years.
Yep.
So it's quite consistent with that. But you're not going to always base your decisions on past numbers.
No, exactly. And the thing is, all of these metrics are from historical metrics. It's all data that's, historical, but, up to date now. Everything in terms of future forecasts, you can only rely on historical data because even forecast population growth, it's still only a forecast. It's not guaranteed.
Yep.
Market activity. So annual sales, 578 sales, which supports that high data confidence. That's a shitload of sales for a market. Projected ROI, and this is based on the hashtag analytics algorithm, and this is they factor in a lot of risk factors as well. So, economic downturns, interest rate increases, pandemics, they forecast everything in. And it's got a projected ROI of -1 to 14% growth. The reason there's that -1 to 14 is because all of those risk factors. So your downside in the worst economic outcome, you're going to get -1% growth. But if all goes well, you've got an upside of 14% growth. So it does look very favourable over the short term.
Yep.
Volatility, like we said, it is a pretty volatile market. Like you do, if you will put it up on the graph, but the growth cycles for this market is constantly just up and down, which for investors is a bad thing, because if you ever go into an interest rate environment that we've been in, and it's been hard for investors to hold their properties, if you sell and you're going through a contraction phase, you don't want to be selling your property in a contracting market, because you're going to be taking a discount.
Yeah.
So supply metrics, it's essentially a super tight market. So stock on market is 0.3%, less than 1 month worth of inventory. There's basically no new approvals for buildings. And there's normally a difference between building approvals to completions. So there's basically no new stock coming to that market. And hold periods, people are holding onto their properties for an average of 15 years. The typical hold period's 8 to 9. So that indicates that family-friendly suburb where if you're holding onto your property for 15 years, it indicates that people like living there.
Yeah, and the days on market is, on average at the moment for houses, is 25 days.
Which is...
That's selling quick.
Yeah, that's selling quick.
It's just surprising that is not then matching growth in that area.
Yeah.
Usually when you've got things that are that hot or that in demand, that usually the capital growth is a lot higher than that we've seen. The vacancy rate sitting around 2.85. So not too bad.
Yeah, it's not too bad. I mean that's. I mean, I would say that's average for a decent market.
Yeah.
Because
obviously people want a lot lower than that, but
you want a lot lower than that. But the thing is, again with those yields, you can minimise that risk with vacancies by buying the right property, because obviously there's going to be markets that investment. There's going to be investment property that someone's had for 10 years. A tenant's treated it like shit. The landlord hasn't put any money into it to increase its appeal, and tenants are just deciding not to move into it. So
yeah, and given the low price, the low cost, it's probably not a huge difference for some people to sit their property empty than it is having someone in there.
And especially for that unit market.
Terrible thing to do, but some people do it.
Absolutely, yeah.
So if you look at the unit market, it is substantially worse.
Yeah.
So typical unit price is around 531. Mm-hmm. Rental income on average around 455 with a gross yield of 4.45.
Yeah.
Better yield, but the growth is really bad. So if you look at the 5-year growth, it's 18%, and 10 years is only 51.
Yeah. So over the 3-year period, it's 3% lower. Yep. Over the 10-year period, it's 30-odd% lower. And that's not too bad when you compare some unit markets to houses.
Yeah.
But that is just a prime example of a lot of investors would just go and buy a unit because you've got 4.5% yields compared to 3%, but you've just gone and got 30% less growth.
Yeah. And
not only have you got 30% less growth, you've got 30% less on 500,000 instead of the extra 30% growth on the $900,000 price.
Exactly.
So your investment is just, it's an inferior investment, and you're purely just buying it based on yield.
For cash flow.
Yeah. Which isn't cash flow because
it's only for...
It's still less than interest rates.
Yeah. So again, not a huge amount of stock on market. There's enough for about a month. No building approvals at all for units.
Yeah.
And people are holding for around 9 years.
Yeah.
Days on market around 36%, and it's a very similar vacancy
Which
rate.
is still like 36 days, that's
still selling
just
quick.
over a month. So it's still selling super quick.
So what's your wrap up of
my verdict on this
Millpark?
one? I think it's going to do very similar over the 10-year period to what it did the previous. around that 75 to 80%, which, like we said, it isn't great.
Yep.
If you're going to be investing in property, ideally you want to be making 100% over a 10-year period and capturing 2 growth cycles to achieve it. So if you're an owner-occupier who wants to live in Mill Park, you're certainly going to increase your property value. But if you're an investor, inferior yields, land tax being in Victoria, but you've also got that vacancy risk, you've got lower yields and you've got less growth over that 10-year period. So
could be good. Could be better. But that's it for today. If anyone's got any areas or suburbs they want us to unpack, drop it in the comments and we're happy to do so.
See you in the next one.
Thank you.